Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Jeff Kilburg, founder and CEO of KKM Financial, as well as Dan Deming, managing partner at KKM Financial. They join me to discuss if the VIX is signaling complacency. We'll talk about the chip trade and some legacy bellwether stocks. Jeff, it's great to see you. As always, we're going to kick it off with you. Dan, great to see you as well. And Jeff, really, that's what the question is. The market didn't get the 6 rate cuts it was looking for, seems to be doing fine with perhaps only 3. We're hitting new all-time highs. Then we take a look at the VIX. Do you think there's too much complacency in the market at this point?
The VIX at a 12 handle does raise an eyebrow for some of the veteran money managers like ourselves. But it's interesting. Fed Chairman Powell, to your point, he greenlighted that there's still going to be 3 rate cuts in the market. If he would have said 3 rate cuts back in November, there would have been some sensitivity. You would have seen the 10-year note, which was traded at 375 just 6 months ago, shot up to 430. But that sensitivity doesn't seem to bother equities. We saw all 3 major U.S. equities make new all-time highs, the 20th new all-time high of 2024 for the S&P 500. So with the VIX at 12, I'm a little more apprehensive up here. I think it's interesting to see. I know Ryan Dietrich talked about it took 757 days to go from 4,800 into 4,900 in the S&P 500. Then it just took 56 days to go from 4,900 up to 5,250. So it seems like a little bit too much too fast, but we've seen this cycle many, many times, Jill, throughout our decades and decades of experience. And sometimes you can see overbought conditions persist longer than any market participant could have envisioned.
Yeah, I mean, that's a great point. Of course, Ryan does pull out the coolest data points. So
Yes.
Thanks for the shout out to that. Dan, I mean, do we even need to do rate cuts at this point? I mean, the data signals that the economy is doing well, certainly much better than many had expected. Is it even necessary? Do we have to do 3 this year?
I would be in the camp that it's not, given the current metrics in the market, Joe, but the jury's still out. This can change pretty quickly. We're seeing a slight uptick now in the labor markets as far as unemployment. This will be a big number this next month because we had, for the first time, seeing, an increase in the rate of unemployment. And typically when you see that start to move higher, it has a tendency to move a little bit quicker than what the market anticipates. So I think that's going to be a big driver as to the Fed narrative. And I think the Fed is still taking that into account, even though certainly when you look at the economic activity, it's still chugging along and the consumer seems strong, and you're seeing it expand into various other sectors of the market, as well as, looking at the driving factors of the markets in general. As Jeff pointed out, we're seeing new highs in the VIX going to below 13 here. And I want to point out, one of the driving factors for the VIX right now is the new highs, but also the realized volatility or the price moves in the market continue to remain at very low levels.
And just to add on real quickly, Jill, just to Dan's point, with this VIX at 12.65, the lowest we've seen in quite some time, and everyone knows that when the VIX is at 16, that's an implied volatility expectation that the market is going to move in a realized fashion up or down 1%. So we're below that. So you're seeing that stair step up, and that's why we're making new highs. But the Fed, the credibility of the Fed is remarkable to me, that everyone believes Fed Chairman Powell, and they've kind of moved the goalposts once again. They're not going to cut rates because they achieved their inflation target of 2%. They're just going to start cutting rates because they want to have dry powder or some other reason. So I think to Dan's point, the narrative is still up for grabs, but the market is betting on that we're getting 3 rate cuts. And I see no real reason to have any rate cuts this year. Right. You have a strong consumer, you have earnings season, which we're going to find out in a couple of weeks, that are going to deliver again as usual. Why are we cutting rates? Clearly, we've been able to withstand these higher rates, and the market is persisting higher. So it'll be interesting to see. But Fed Chairman's credibility, once again, we're giving him the head nod or the hat tip. But if we go back to 2021, in the fall of 2021, when they talked about inflation being transitory, they were dead wrong. I don't understand why the market is trusting the Fed.
Yeah.
Yeah.
Mic drop there, right?
Yeah. I mean, it really was. Jeff, I don't want to say it's contradictory. I don't mean to be flippant like that, but the whole thing is saying that you don't necessarily trust the Fed. I think they've been, to some extent, transparent by saying if they're not going to cut for the sake of cutting, because they do have these specific data sets that they are reliant on. I don't think he was signaling anything any different than the talk track that he's been on. I mean, to me, it doesn't sound like he's going to cut just to satisfy what the market wants.
I'd push back, because if they truly are data dependent, which I don't think they are anymore, if they're truly data dependent, then the recent outliers that we've seen, the hotter than expected PC and CPI data, they'd have to wait for that to come down. So the data dependency Doesn't feel like that. It feels like they're going to cut in June. I know the CME group, FedWatch Tools, about 70% right now that rate cut's going to happen. But it seems more, and I hate to say it here, I'm not starting a controversy, but it's an election year, and this seems political. They're going to cut a rate before the fall, which is the election. So it just seems a little too it just seems too colluded to me. And we actually saw President Biden, I'm not getting political, but President Biden 2 weeks ago said that he bets. I was on with Brian Sullivan on CNBC, and Brian Sullivan talked about this clip where President Biden said he bets that the rates are coming down. He talked to that little outfit referring to the Fed. So it just seems like there's a lot going on. And the market participants, we just have a little bit of euphoria going on with all the chip makers continue to persist higher.
Right.
Yeah,
well,
I mean, I'll run with that a little bit as, I think the jury's still out. I mean, that's the narrative, and he's going to stick with that because it seems like a fairly safe narrative. It's a dovish narrative, but again, if we continue to see inflation ticking higher, holding above, say, 3%, we get the PCE number next Friday when the markets close. That's going to be an interesting dynamic as we kick off a new month. If inflation continues to hold up here and the economy continues to maintain with no significant shift in the unemployment situation, then I just don't see them cutting this year. They can keep that storyline alive for another month or two, but it just feels to me like eventually they're going to have to answer to the trends that are in place.
Mm-hmm. And Jeff, speaking of the chip trade, I want to reference an article that you wrote for CNBC Pro. Well done as always. You've done well, right, with the chip trade. If you're holding that within your portfolio, what are you thinking of right now? Are you looking to take some gains on that and let the rest ride? Are you looking to write some option strategies around it, maintaining your portfolio? What are you thinking here?
We're keeping our chip exposure. It's been a winning formula, right? But it's interesting to see if you look in the last year, and we utilize SOX, SOXX. That's one of our holdings in our sector rotation, which is powered by Nasdaq Dorsey, right? And SOX is an interesting holding because the top three constituents of that is Broadcom, NVIDIA, of course. Why did I not mention them first? And AMD. But those three collectively, Jill, in the last year are up on average 150%. So the CNBC Pro article I pushed out there was buying a put spread, and it's an insurance trade. It's the opportunity to potentially book some profits if we do see a pullback. Now, I know that defies all odds of chip makers actually going lower, but a pullback of 5 or 10% seems completely plausible in this overbought situation of all these chip makers.
Yeah. Dan, any thoughts? What would you be doing with your portfolio if you've had a really nice year?
I mean, I think I certainly support Jeff's argument there. I mean, to me, as far as being, in the markets for 30 plus years and seeing these extremes periodically over the years, by pretty much any metric, the market is overbought. So that eventually you're going to see a mean reversion, but, at the when is still the jury's still out. But at these levels, it does, to me, make sense to at least hedge out some of the exposure, particularly if you've captured a big chunk of this move on the, when you look at the stocks, when you look at these big chips that are, doubled in value in just even less than a half a year. And as Jeff pointed out, there's other opportunities out there in the options market to, again, lay off some risk depending on, the metrics that you're trying to define, if it's covered call strategy or put spreads to protect to the downside. But yeah, I think that Jeff and I we've been evaluating this for the last month or so, as far as, again, looking for ways to defend if we do ultimately see some selling pressure.
And Jill, just to kind of put a bow on that box of why we're deciding now in this moment in time, if you rewind to last quarter when NVIDIA went from 450 up to 600, the relative strength index on NVIDIA was overbought then, but we're seeing that stock price up another $400. So instead of selling NVIDIA, we can define our risk by a put spread for an X amount of dollars. And if it expires worthless, that money just goes up in flames like a typical home insurance plan. That's okay, because we are still able to participate in NVIDIA from 450 up to 950. So that's why understanding options, utilizing options, we work with a lot of clients, a lot of family offices, implementing an option overlay so they can keep that underlying exposure. If it's single security like in NVIDIA or if it's an ETF, it still allows them to participate because we're not always going to be right on timing, as you know.
Right. Well, of course, you could never time the market, right, Dan?
Correct.
All right. Well, you know what? Let's shift gears for a moment here, Jeff, and talk about two bellwether stocks that were in the KKM model portfolio, Essential 40. It's refreshing to kind of get away from the tech trade for a moment, but two bellwether stocks. We'll start with FedEx first. Jeff, before our economy shifted to a technology-based economy. I mean, everything was about FedEx. That was the bellwether. That was a one stock that you cared about during earnings because it was a global macro read.
Yeah, so we like to own FedEx over UPS, but both of those bellwethers really give us an understanding of that global macro read. And it has gotten lost a little bit, Jill, but it's interesting as we're seeing the last maybe 5 or 10% of this S&P 500 rally, as it's starting to broaden slightly, it is important to understand some of these industrial names, some of these FedExes and even a Home Depot to help us better understand what's the actual state of the economy. Because I understand the NVIDIA chips, that's kind of the new euphoria. But at the end of the day, there's still a whole part of our economy that's critically important. So that's where the essential portfolio, which we believe FedEx is essential to the U.S. economy and the American way of life, that gives us an opportunity to understand what actually is going on, because you get blinders on when you start looking just at one vertical or one sector of the S&P 500. And I think there's been some blinders on specifically in semiconductors. Let's just remember 18 months ago, no one really wanted semiconductors, right? And you saw what happened in 2022. So there's just a lot of emotion in the tape. And that's why we like lean into some of these essential names like a FedEx or Home Depot.
Yeah, 3M too, Jeff.
And a
3M's
3M,
another
great
one.
point.
Yeah. Well, you know, what's interesting with Home Depot, we saw what happened with that stock at the beginning of COVID when people were doing renovations, DIY projects, building home offices, making extra space for the kids because we all had to live in the same space. We had a housing panel yesterday on Trade Talks, and they were talking about, because there's such low supply in the market and it's hard for first-time home buyers in that particular segment of the market, or people who've been in their homes for a while are anxious to sell because they're not sure that they're going to have a place to buy. So what's happening now is they're seeing renovations really uptick, whether they are just doing a complete redesign, adding on more space. So it's almost like that renovation trade is coming back into favor.
Yeah, I think it is. And I'll let Dan jump in here as well. But I think the mindset post-COVID, potentially instead of taking that trip, people are talking about, a jacuzzi or an additional bedroom with bunk. I mean, the whole mindset has shifted. And I think that's where you're seeing Home Depot. It was a kind of a knee-jerk reaction, certainly out of COVID, because everyone stayed home and we're trying to do it yourself projects, even myself. And there's still a couple projects that aren't done because I couldn't figure out how to finish them. But nonetheless, people are revisiting that.
Yeah, I agree, Jeff. And it is cyclical in nature as well. We did see kind of that transition during COVID, where everybody started to just put money into their homes, but then we came out of it. In the last couple of years, I think people have been focused on just getting out. But now, as Jill pointed out, the inventory, the issues in the housing markets, as far as the short, inventory and the difficulty in finding something once you decide to list your place, is there many people are kind of making that move now where you are just going to upgrade where you are, and that could lead to another cyclical pattern. And I think that's benefiting, some of these the consumer stocks, and and for certain Home Depot benefiting, and FedEx to some degree as far as activity, the shipping, and the nature of the transportation.
And they're not inexpensive, right? I mean, Home Depot is trading at a 25 times forward earnings, which is, high on a historical average of the last 5 years. But I think there's a reason that people want to own these names, that they're kind of leaning not into, or away from the chip makers. But I think there's just been so much profit. You look at the cost basis of some of, our clients that we've seen in NVIDIA, and we've seen in Tesla, and even Meta to a certain extent. Any AI play that you have, Amazon, Google, they're all kind of collected together. So having some diversification is really important, despite the fact that you could argue that Home Depot is maybe at a little higher end of its valuation.
Agreed. Yeah. Again, 3M would be another one that would be participating in that kind of trend as well.
All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.